Hello, and welcome to Accolade's Market Update for Credit Unions. My name is Phil Lucas, and I'm the Senior Balance Sheet Advisor at Accolade. I'm also joined by our VP of Advisory Services, JD Pizzula. This update is part of our ongoing effort to support credit unions, as we look to summarize and condense the most important developments over the last few weeks, as well as highlight a few areas of focus for credit union strategy. This recording was made on January 20th, 2022. On Tuesday, the NCUA released its 2022 Supervisory Priorities, which will be our primary focus for today, followed by an overview of investment opportunities at the end, as usual. For each regulatory priority, we'll briefly overview the subject, as well as provide relevant commentary or context as we deem appropriate. Similar to last year, credit risk management is front and center for the NCUA this year. The industry has fortunately been blessed to not see widespread credit problems through the pandemic era, as extraordinary efforts on policymakers have served to improve household balance sheets over the past 2 years. The NCUA mentions that their focus will be on programs offered by credit unions to further support those impacted by financial hardships. The NCUA emphasizes that examiners will not criticize credit union efforts to assist members impacted by the pandemic, and focus will be placed on the oversight of these programs, including controls, reporting, and tracking processes. The NCUA's letter does not make any indication of expectations for a significant increase in credit risk exposure, but rather that new programs as introduced in the CARES Act or similar provisions introduce new complexity or possible learning hurdles, which will need to be managed appropriately. Cybersecurity remains a perennial examiner focus for 2022. This category includes credit union efforts to defend against ransomware, risk introduced by working with third parties, and phishing attacks. Examinations will be conducted depending on the size and complexity of the credit union, according to the NCUA's newly released ACET program. Cybersecurity as a category is primarily focused on reputation risk, as the trust relationship of members is based on the presumption that the credit union will keep both their dollars and data safe. New to the examiner priorities list this year are payment systems. This category refers to electronic fund transfers and settlements, which are evolving to meet member demands. Because the payments landscape is evolving, the NCUA is concerned about higher potential for fraud, illicit use, and data breaches. Corporate One has been leading significant efforts to bring payment system support to natural person credit unions, primarily through their QSO Sherpa technologies. If you'd like to learn more about these offerings, let us know. Another perennial examiner priority for this year is BSA and AML. The most important update here is that some new requirements have been added in recent updates to the AML Act and Corporate Transparency Acts. The NCUA is committed to communicating these updates through the year, and we expect that implementation to be incremental. Capital adequacy merits its own category on this year's letter. Notably, the NCUA has been a bit more lenient on regulatory capital ratios in light of the rapid expansion of credit union balance sheets due to stimulus efforts. The letter expresses a continued commitment to be understanding, but also an expectation that credit unions will continue to evaluate the impact of those balance sheet changes on their capital positions and ongoing earnings. With the Fed expected to increase rates a few times this year, we broadly expect to see an improvement in credit union earnings, which should be additive to the normalization of our balance sheets and earnings over time. As we mentioned in our previous update, the final risk-based capital rule is now effective for complex credit unions, as defined as being above $500 million in assets. Examiners will also be reviewing the accuracy of the new capital calculation, starting with the March quarter-end call report cycle. Loan loss reserving, or CECL, was last year's foremost priority. The current deadline for the new FASB rule, which would implement CECL, is January 1st of next year. Credit unions under $10 million in assets are currently exempt. Examiners will be focusing on the following subjects: ALLL policies and procedure, reserve methodology, assumptions, and qualitative factor adjustments, GAAP adherence, and an independent review of the reserve methodology by the Supervisory Committee or auditors, for example, a validation of the process. We have noticed in recent exams that examiners are focusing on management's ability to clearly explain the criteria for the different risk buckets that loans are placed in for CECL evaluations. Accolade offers multiple CECL solutions that include tools to assist credit union managers, both with the calculation as well as the rationale and methodology for the process. And we're committed to continue to expand the support documentation to address examiner questions. While the CECL implementation has been delayed multiple times, to the best of our knowledge, it looks like this deadline will be the real one. Consumer financial protection makes the list again this year. This subject dovetails with some of our previously mentioned topics, but has a greater emphasis on regulatory compliance. Examiners will focus on COVID-19 pandemic-related programs, fair lending, Service Members Civil Relief Act, Fair Credit Reporting Act, and overdraft programs. Perhaps most notable here are the overdraft programs, which has been a bit of a hot topic in terms of what different financial institutions are offering. Notably, the NCUA mentions that a larger focus on ODP programs will be made in 2023. Some larger banks have begun to do away with ODP fees or are redesigning these programs, which could have a ripple effect on member expectations in the future. It's worth noting as well that credit unions typically have a higher percentage of earnings driven by overdraft fees than larger banks. Just a few more topics to cover. Loan participations are on the list this year. The NCUA continues to offer some wider than normal latitude on loan participation concentration limits in 2022. Examiners will focus on ensuring that credit unions have properly evaluated the risk parameters on loan participations and ongoing monitoring of both the performance and risks on any such assets. Fraud has its own brief topic in the letter, in which the NCUA specifically is concerned that internal controls and separation of duties are managed as the support staff for many credit unions may have moved off-site, remote, or from work-from-home arrangements. LIBOR focus has evolved per a couple of update letters from the NCUA. 1 week and 2 month LIBOR have been sunsetted, while other LIBOR terms will continue to be published through June of 2023. As a result, the NCUA LIBOR assessment workbook has been updated to focus on exposure to the sunsetted LIBOR tenors, as well as focus on any outstanding LIBOR contracts having sufficient fallback language to successfully transition. As a reminder, SOFR will largely be the LIBOR replacement, and Accolade continues to evaluate any investment-related exposure to LIBOR for compliance in this area. We have prepared a memo for our investment clients on the new LIBOR workbook and changes to our monitoring process that will be distributed in the coming weeks. The final examiner priority in the letter is interest rate risk. Interestingly, the letter acknowledges both the potential impact of holding too many long-duration assets as well as holding too many short-duration assets, perhaps signaling a more balanced approach to managing upside and downside risk. We anticipate that we'll see increased attention in this area as we are expecting a rising interest rate environment this year and beyond. Such conditions should offer more flexibility with potential interest margins for credit unions, and determining the optimal balance between the need for current income and protection from changing interest rate risks will be critical to strategy. To conclude this section, we'll cover odds and ends from the letter. Due to ongoing COVID-19 spread, the NCUA expects to continue to conduct exams off-site or remotely. Flexible exam scheduling will continue to be offered this year, and credit unions below $50 million in assets will continue to receive the Small Credit Union Exam Program. The NCUA has a new exam platform called Merit, and 2022 exams will include some training for credit union staff on how to use this tool. Credit unions may record their meetings with exams, such as exit conferences, but they must have the examiner's consent to do so. And the NCUA encourages credit unions to review all legal regulations before doing so. Finally, the CAMEL management rating system has been updated to CAMELS. The L for liquidity component previously encompassed both liquidity and interest rate risk. Now S will be a separate component to reflect the risk of changes in earnings and capital to different market pricing or rate environments. If you have any questions on these regulatory priorities or how your credit union may address them, feel free to reach out to any of us at Accolade.
All right, and let's wrap up today's presentation with an overview of some investment opportunities right now. So as demonstrated on this yield curve, you can see that yields have really ratcheted higher over the last month as we've started to price in the reality that the Fed is likely to raise rates 4 times this year. So we're looking at 4 interest rate hikes this year, and we're seeing that being priced into the yield curve. We're also seeing that in floating rates. 3-month LIBOR is now at 25 basis points. It had been in the high teens just about a month ago. So we're seeing 3-month LIBOR now start to price in future rate hikes as well. 1-month LIBOR hasn't really moved all that much because the market's not pricing in that first rate hike until March. Likewise, SOFR and Fed funds are unchanged until we're right on top of that rate increase. And really the way that SOFR works is you've got to see the rate increase, and then over a multiple day period, you'll see SOFR start to reprice into that higher range. But we're seeing it in the fixed income yield curve already, and you can see that at these tenors as you move out the curve. We're seeing opportunities for 2% right now for credit union investors that are willing to tack on some duration. We see that in some callables where you're selling a ton of options to the issuer. So right now I saw a 5-year no call, 1 month, and then monthly call, I believe it was at 2%. You're seeing some 7-year callables that are at 2%. And for municipal bonds, you can also see some taxables that are close to 2%, right around there, but you're taking on some credit risk. In planned amortization class CMOs, we're seeing spreads of around 50 basis points generally to 5-year treasuries, probably a little bit better than that. And that also gets you well above 2% and around 2.16%. With a 5-year at 1.66%. So you're seeing with these higher rates that there are some opportunities to capture some yields that we haven't seen for a little while, which is great for credit union investors, especially those that are looking at things other than brokered CDs, because that market still remains ugly. Every financial institution that's usually in this wholesale funding market, they've all got more cash than they know what to do with, so there's really no incentive for them to keep those rates up. But if you're looking at other products, you're seeing yields that we haven't seen since before the onset of the pandemic.
Our next update will be released on Thursday, February 3rd. Accolade is a registered investment advisor, and I'm required to ask you to review the disclosures on the last slide here. We believe that credit unions are uniquely positioned to improve the financial lives of their communities, and doing good work for them can lead to relationships that will last a lifetime. Wishing you all peace and health, and talk to you soon.